Do you have a small portfolio? Maybe you only have $5,000. You might only have $2,000. You might only have $1,000. But what if I told you that you could turn $1,000 into $10,000 very safely, passively? Do I have your attention? Well, stick around because I'm going to show you how to do just that. Hey guys, Corey here and welcome to the channel. Hope you guys are having a great day. Be sure to subscribe, tap the bell if you guys enjoy the content and you want to know when I post new videos. Be sure to subscribe and tap that bell so you know when I post new videos. And you can give me a thumbs up as it greatly helps the channel. Be sure to sign up for the free newsletter right there on the screen as well as in the information box below. That's where I'll put the link. You can sign up for free information, tips, and strategies delivered right to your email box every week. And not only that, for the first 100 people to sign up from this video are going to get free trade alerts for the first few weeks. You can see on the screen all the people that have taken my trade alerts and have made money over the past couple of weeks from SoundHound, Palantir, Upstart, Neo, SoFi, and many others. Starbucks, even Shopify. And sign up for the exclusive memberships. You can do that and join right below this video or on the main member page. There's also a link in the information box below where you can become an exclusive member of Invest with Corey. So high five, guys. We're doing great. You guys are doing an excellent job this last couple of weeks. We're making money. But I'm going to show you guys in this video how you can turn $1,000 into $3,000, $5,000, or even $10,000 very passively too and safely. Now, you're not going to make that money overnight or even in a week. That's gambling. And if you want to gamble, that's for a casino. My channel is for teaching you reliable long-term strategies to compound your wealth and grow passive income and to not have to worry about making huge risks and losing money in the stock market. I want to show you my favorite strategy today for 3xing, 5xing, or even 10xing your money very quickly or relatively quickly. And when I say relatively quickly, I mean 6 months to a year in a very safe fashion. I want to show you my trade and how I do this. I am going to enter in an option, a long-term option, sell calls against it, and show you guys how we can benefit from the price staying the same or going up. Let's dive right in. First, I want to point out that I'm not a financial advisor, and this is not financial advice. I'm just showing you guys strategies, tips and tricks, financials, fundamentals, technicals, and teaching you how to valuize companies and learn how to make certain strategies work for you. However, it's ultimately up to you to decide which stocks you want to get into and how much of a position size you want in those said stocks, as it's your money. So what we're going to do is we are going to buy a long call option way out of the money. This way we can benefit over time controlling 100 shares. And as the stock stays the same or goes up, we don't lose really any value on the long call, and we sell short calls against it, collecting weekly premium. I'm going to show you an example I did on Affirm. And the reason I did this on Affirm is because it's a pretty volatile stock, which is good because you'll make more money on a volatile stock going up, but you don't want stocks that are going to jump from like $30 to $40 overnight because that can put you in a serious predicament. You'll end up having to roll out your short contract and up like $10, and you'll end up having to roll out 3 or 4 months, and any more than 1 month and you lose volatility on the premium of the short position. So you don't want to do this on a stock that's going down, and you don't want to do it on a stock that's going up fast. You want to do it on a consolidating stock, one that goes up and down but slowly works its way up. Affirm is the perfect candidate. Nike's another good one. Apple's a really good one, but you're not going to be able to, do anything with those stocks with $1,000. But with Affirm, Best Buy, Nike, Roblox, those stocks you can, but I really think Affirm and Nike are the better of the two. I think Affirm's better than Nike, though, because Nike's a dividend stock. And anytime you get into dividend stocks, they don't have much volatility unless it's earnings or a big catalyst. So let's show you guys exactly what I'm talking about. I purchased a call option on Affirm expiring January 17th. And this call contract has been in my brokerage now for over a month. I did it really specifically for this video because I already have like 1,000 shares of Affirm in my large brokerage. So I really don't need this contract. But this is my small brokerage, and I'm trying to grow it. And it was part of my challenge to myself to grow from 1,000 to 20,000. And I'm already at 14,000 in this account, and I'm using it to do these videos. So perfect example. I opened this up, went through the selling calls for a month, and now I'm going to show you in this video exactly what I've done so that I can show you how the process works. First, you want to find a contract, and we're going to use Affirm in this example. You want to go out at least 10 months to a year. The best months for doing this are January, March, and June. So let's just say hypothetically, we're going to look at March 2025. 35. We're going to buy a $30 Affirm contract. Now, Affirm's not going to go below 30 or even 31, really. I think this is the hard floor. And I'll show you what I'm talking about when I go over here to Affirm. The 1 year projection is 36. It's most likely going to be closer to 40 because they were valuized at being undervalued. Most recent report came out and said they're undervalued. I anticipate Affirm's going to go back to its recent high somewhere up here of $40 by the winter time, especially if their earnings get better and inflation gets better. I see them by the end of the year going up to at least $40 or pretty close to it, like at least up here in the 37 to 40, right where that says it's going to go. But we're going to play it just like this says, $37, okay? So you are going to go in here and buy. So we got some good volume, pretty decent. Open interest is big. Click on buy. We can see that the mark is 1,065. The bid's 1,005. You could probably get filled for 1,050 on this. So we'll just say 1,050. 1,050 per contract, or excuse me, 1,050 per share, 1,050 per contract. Okay, so you will buy that for 1,050. And you'll see that the theta is 0.153. So it loses $1.50 a day. So as long as Affirm goes up by 7 cents a week, you'll lose nothing on this. And even if it stays the same, the worst case, you lose $10 a month on this contract, maybe 15. But with the covered calls you're going to be selling, you're going to be way in the green because Affirm, you're going to be able to generate $300 to $500 a month in passive income with covered calls. So you're basically owning this for free. And you can see the delta is 69, which means every time the stock goes up $1, this contract goes up 70 cents. However, Gamma will raise Delta by 0.142, which means every dollar it goes up, this will increase. Delta will increase by the Gamma amount every dollar. So if Affirm goes up to 32.60, this Delta now becomes pretty close to 71. It'll eventually get to a point where it's 1-to-1, but Affirm would have to go up to $40, which is what I'm saying it will. Meaning when this contract expires next March, right before expiration, it will have no time value left except its intrinsic value. And since it's a $30 contract, if the stock price is $40, this will have $1,000 value, meaning you get all your money back, all of it, even on the day of expiration. And all the call premium you collect from now until next March, 1 year or 11 months, is all yours to keep. If Affirm goes to 45 by expiration, this contract is worth $1,500. So now you're up $500 on the contract, plus everything you collect in between. Realistically, I see Affirm being between $700 and $1,000. So you're going to get back most, if not all of your money on this contract in a worst case scenario. There is a situation where if Affirm goes to $40 or $37 in the first 3 months, you could sell it for a pretty big profit. Let me show you what I'm talking about. So I have a $30 call on Affirm right here. And if Affirm was to go to $37, I paid more for this contract, $100 and something too much, because I got it a little earlier. My price was $1,280. Yours will be like $200 less. So you'll be at a $300 profit. Even in September, you guys will be at $150 profit plus the calls. So short term, even in 3 to 4 months, you could make about $2,000 plus the gain on this contract, which is a couple $100. So you could turn $1,000 into $3,500 in about 3 to 4 months. It's a 3x return in 3 months. However, I'm going to play this long term, and I expect Affirm to go relatively to $40. So my contract, which I bought for $200 more than it currently is, because I bought it a little bit higher, and the price has come down due to earnings. It slid because of all the fear mongering in the market, and mine is also a January contract. So come December, my contract at $37, where it's expected to go, I'll be negative $400 on this, whereas you guys might be negative $200. However, the call premium that you've collected, let me show you that. I bought this contract, sold an 85 call, sold another 32, rolled it for an 84. So right after I bought this long call, I sold an $85 call, juicy premium, $85. Then I rolled it for $32. Then I rolled out and down for $84. Then I rolled down the same week because Affirm dropped. So I rolled down the same week and collected another $41 juicy premium. Then I sold an $80 call. Then I rolled out and up because of earnings, 2 weeks, collected another $141 juicy premium. Then I rolled out again, another $29 premium. Then I rolled out and up again for another $52, collecting a grand total of $544 in just 4 weeks. We look at my contract right now, and I am in the negative $331. However, I've collected $554 premium, and this contract is $2 out of the money or more, $2.40 out of the money, which means it's going to expire worthless this week. And if it does, that puts me at $554 minus $331. So I am $223 in the positive right now over the past month, which is about $60 a week. So let's look at this. Let's do the math. I paid $1,240. The contract's worth $910. So I paid $1,240 for the contract. It's currently worth $910. That puts me in the hole negative $330. So we're going to do 544, take away 330. I'm up $214 in 1 month. However, Affirm is going to recover, and as it's starting to go up, it'll eat back all of that loss. I'll get it all back. It's going to chew into that. So as Affirm goes up, and it will, it's already starting to make its move. I'll show you right here. It started to come up, then the sell-off happened with all the fear-mongering, and now it's leveled off and going to start moving its way back up again. It might come down a little more, but I anticipate by the middle to end of May, we'll start rebounding at the latest into June, back up to 35. So what happens is, by the time June comes around, let's say we'll go mid-June right here, and Affirm is back up to 35, I'm only out $150. And at that point, I'll be well into $800 in premium. So I'll be up over $700 in a 2-month window. 8 weeks, $700-800 profit, and Affirm still has more upside to go in the coming months. And this is not even the best example of this strategy. So I'm averaging, now that Affirm is settled and it's going to start working its way back up, I'm averaging about $80 a week in premium. Maybe a little bit more because I've also been able to roll down and roll out. But on average, you'll get between $300 and $400 in this specific example. So let's just say we're doing $400 a month times 11 months because you want to sell this contract right before it expires. So we're going to do about $4,400, okay, in premium. So we're doing $4,400 in premium. And then if this contract ends up back at $37, like it's projected to be at, and we get ourselves all the way down to December, which is about a month before, see, I'll be in the negative 416. However, I paid $250 too much for this contract as it was a higher price. You guys can get in now for less. So you'd be like maybe negative 200 or negative 100 at worst case. So you guys would be like around negative 150. Then again, you're up 4,400. So about $4,200 profit. So 4,000 to 4,500 in about 11 months. So you turned 1,000 into 5,400. That's a 5x return the same year. So you sell the contract back for pretty much relatively what you get for it, just under $1,000, and you add that to your 4,400, you have 5,400. You turned 1,000 into 5,400 in 11 months. It's a 5x return. However, if Affirm continues to go up and you keep rolling out and up, and let's say Affirm goes to 45, which it very well could do because it's done this many times in the last 2 years, right at expiration, you'd be looking at, well, I'm looking at 305, you'd be looking at 500 because you're getting in cheaper at 1,000 versus 1,250 or 1,280. So you'd be like a $500 profit. So you would sell the contract for $1,500 plus your 4,400. So you're at $6,000. So you turned 1,000 into 6,000. That's a 6x return for a very safe strategy. So if you're asking me what happens if the stock price goes down and your contract goes down, well, that's easy. I'm already in that position and I'm still up. The contract right now, I'm in the hole negative $331. And I'm just going to keep selling covered calls at $34 and $35 over and over and over. And I'm going to collect $300 to $400 a month. So in 10 months from now, I have 4,000 plus the 500 I've collected, which is 4,500. And let's say I sell the contract in December at a $900 loss. I only get $340 back. So let's bust out the calculator yet again. I'll make $4,500 plus $340 for the contract is $4,840. So I'll turn 1,000 or 1,200 into 48. So I 4x'd my money even in the stock that went down. So the stock went down and I still 4x'd my money. And it really doesn't matter if this contract degrades to nothing. Let's say a firm goes to $26. I'm only going to get $55 for the contract, but I'm still making $4,400. So $4,400 plus 50. I still had a 3.6x because we're still going to keep rolling out and down, out and up, or out and staying the same. We're just going to keep collecting premium and just keep rolling. So this could be a 3x or a 4x or even a 5x. It could relatively could be even a 6 or 7x, because if a firm was to go to $50 at expiration, it's worth $2,000. So let's just say we collected $4,000 in premium because we lose a little bit on the rolling. So let's say we collected $4,000 premium because we might lose a little bit on the rolling plus $1,900. There you go. That's a 6x return. So worst case, 3x, maybe 4x. Good is a 5 or a 6. And great could be 6 to 7, maybe even 8 or 9, depending on how much the stock price moves. This is a very safe strategy because the most you can lose is what you paid for the contract. But you're going to make about 3 to 4 times the amount of the contract in a year. Even if a firm was to drop to $22, this contract is worth nothing. But you can still sell calls. However, selling calls would require a spread in this situation. The difference between your call contract of 30 and the stock price of 22. If you sold a $31 call, you'd need to put up 900 to collateral. You'd have to put up 900 in collateral to sell that because you're out of the money. So this situation would get sticky is you'd end up having to pay $200 to $300 more to roll down to 25 to sell $25 and $26 calls. But even in that situation of having to spend $200 more to go down to a $25 strike, you're still collecting the same premium every week relatively. So $4,400, then at the end of the year, your contract's worth nothing, plus you had to pay $200 to roll down. You're still at $4,200. Even if you paid $400 to roll down, you still $4 extra money. Okay, so even if the stock was to go down $8 and you had to spend another $300, $400 to roll down on the contract to go from a $30 call to a $25 call to keep selling covered calls, you're still 3xing or 4xing your money. So worst case, you're at a 3x. Neutral, you're at a 4 or a 5x. Good, you're at a 6, 7, or 8x, depending on the stock and how you play it. It is a very good strategy. Okay, so we look at this on a whiteboard so you guys can get a visualization of it. You pay $1,050 for the contract for a $30 call. And we're going to go with worst case scenario, like it goes down. So you pay $1,050. But then on this side, the calls that you're selling, you're doing a safe strategy of, say, $80 a week times 4 weeks is $320 a month. And then you're doing $320 a month times 11 months. This is $3,520 in the 11 months. And then let's say you end up having to roll down because a firm goes down. So you have to spend another $300 to roll down to a $25 call. This way you can sell $30 calls, because you can't sell a $30 call with a $25 call unless you pay a $500 spread. Whereas if you have a $25 call, you can sell the 30. So now you have $1,350 wrapped up in this worst case, but you've made $3,520. Okay, this is the absolute worst case. Then on expiration, if a firm is only $27, you can then sell this contract for $200 because the time value is gone, but it's actually worth $200. Its intrinsic value is worth $200. $25 call, $27 strike price, $2 difference. You can sell it for relatively $200. So now you have $3,720. So you've turned $1,000 into $3,720 in 11 months, which is a 3.7x return, almost 4 times. And that is worst case scenario. Now let's look at a more realistic scenario that it stays relatively the same price or it goes up a little bit. So you spend $1,050 on the Affirm call for $30. And then you sell $80 a week times 4 weeks is $320 a month. 320 times 11 equals $3,520. And let's say a firm goes to $37 or $35. Let's just say $35. So if a firm goes to $35 from $30, that means this contract has an intrinsic value of $5 equals $500. So you now sell the contract about a month away from expiration for $500, plus you've collected $3,520, which is $4,020. So you have turned $1,050 into $4,020. That is a 4x return. And this is just the neutral strategy. If a firm was to go to $40 or even $37, where I think it will go, your intrinsic value will be a lot higher. Obviously, it'll be $1,000 instead of $500. So you'll be able to sell this contract for $1,000, and then you'll add that to this. So you'll be at $5,020. That's a 5x return. So realistically, worst case 3x, the normal situation would be a 4x, and good situation, you could be a 5 or even possibly a 6x return. And it's very safe because when the stock goes down $1, you're only losing 70 cents. So instead of losing $100, you lose $70, and you still get to sell these calls. So here's a chart. This is stock price right here. Price. This is time. Okay. This is the stock price. People who own shares. This is share prices. This is the call contract. And then what we're going to do is, this is in the money right there. That's how much money a shareholder would lose. With the call contract, this is how much the call contract could lose. Do you guys understand this? What's happening here? You cannot lose any more than you paid. So the shareholder could spend $3,000 for 100 shares. If the stock price goes to 0, the shareholder lost 3,000. Whereas you, if you buy this contract for 1,050 and the stock price goes to zero, you lose 1,050. So the shareholder spends $3,000 for 100 shares. You spend 1,050 for 100 shares. So you get to make all the premium, sell all the calls, except your exposure is 1,050. The shareholder's exposure is 3,000. 3 times the exposure. So you have 3 times less exposure to 4x your money, or 5x your money, or even 6x. So instead of spending 3,000, you can spend 1,000. So you're making a higher return with less risk. So less risk, higher reward. That's the situation we're in right now. You're spending less money to make more money. 1,000 to 5,000 instead of 3,000 to 6,000. Like, because he's still going to make the same premium of $4,000, but he bought the shares at 3,000. He had to put up more money with more risk. There's no need to do that. You can just buy the call contract, deepen the money. And if you have to roll down and out a little bit, you can go out 3 more months and go down $500 for about $400. And you'll collect that premium back in a month or 2 of calls. And then the next month or 2, you make it right back again in profit. So it makes more sense to do this, as it's a better and safer strategy. So ultimately, it's much better to just buy long call options than it is to buy shares, because the shareholder is risking 3 times the amount of money and he's getting the same reward that you would get by buying a long call option. You're not exposing yourself to the risk of $3,000. You can only lose $1,050, which is what you paid for the contract, yet you can still 3x, 4x, 5x, even 6x your money as soon as 8 to 10 months, but realistically 10 to 12 months, which is a very good return considering the S&P 500 only ranges between 5 and 20% per year depending on the pullbacks. You're looking at a 300 to 600% for very little risk. So you can see quite easily how safe and how consistent and yet still passive you can be with this strategy. Not only that, as you only have to check your brokerage account to manage this strategy a couple of times a week at the most, you might be 10 to 15 minutes a week worth of work to 6x your money potentially, which is exactly what I want to teach you guys how to do, because you might be a doctor, a dentist, you might run your own business. You don't have time to be checking your portfolio. So basically you can 3x or even 6x your portfolio doing very little work and having very little risk. Thanks so much for being here, guys. I really appreciate you. If you enjoyed the video, be sure to subscribe and tap the bell so you know when I post new videos. High five, we're making great money. All my trade alerts are going out, so you might want to sign up for my free newsletter right there on the screen and in the information box below. The first 100 people that sign up right now get free trade alerts, but you're also going to get tips, strategies, and weekly updates right to your inbox for free. And I want to let you guys know that I will have a very exclusive course coming up for a select few people, and that'll be coming up in a few weeks, so keep your eye out for that. You can also join the exclusive memberships right below this video to support the channel and become an exclusive Invest with Corey member. And I know you guys might be a little upset right now that this video is over and you want to see more content and you want to learn more. Well, guess what? It's okay. I picked another video just for you to watch, and it's right there. It's right there for you guys. I know that's the one you want to see, so click it because it's going to be just as good as this one. Of course, all my videos are good, right? Click on that right there. You guys are going to enjoy it, and I'll see you over there. Let's grow our wealth together.